Hey there, everyone. Welcome to Chart This with Dave Keller. It's Election Day, Tuesday, November 5th. We're coming to you live from a sunny and beautiful Redmond, Washington. Thanks for joining me every weekday after the close as we try to digest the market action using the lenses of technical analysis, investor psychology, and behavioral finance, especially on this very heavy news-driven day and news-driven week. This week sort of has a little something for everybody in terms of big macro influences, right? We have a ton of earnings coming out this week, and that's sort of way down the list of important things because it's election day here in the United States. We have the Fed meeting coming up Wednesday and Thursday. A lot of potential catalysts for the market going higher and or lower, and maybe a mix of things in between. Having said that, we're sort of balancing the long-term strength that we've observed through much of 2024 with some instability, some elevated volatility, elevated uncertainty, certainly in no small part due to a very contentious election season, culminating in the events of the day here. But I think a lot of our attention going forward is going to be just how we navigate out of this period, right? Once we hopefully get some closure in terms of what administration will be in this hot seat here in the United States, we'll figure out how the ripple effects of their policy decisions and expectations and so forth through the course of the week. Hopefully, we'll be able to fill in some of those question marks. And as a reminder, if you are based in the U.S., please go out and vote. You have a voice, and please make sure you use it. We vote all by mail here in Washington State, but my wife and I both have, and I would encourage you to do the same. All right, with that in mind, let's get to our market recap and look at how things played out through the course of the day today. Kind of a nice upward day for the major averages. A little bit of optimism. Am I detecting optimism from the investing community going into this contentious election day? Apparently, with the S&P 500 pushing nicely higher, about a 1.25% to the upside, finishing just above 5782. The Nasdaq Composite 1.4% to the upside. The Dow just about 1% higher. Mid caps and small caps all getting it done as well. The S&P 600 small cap index, the best performer of the bunch, up about 2% today. And that's an interesting theme, to be honest with you. Smalls have underperformed large stocks pretty much for the entirety of 2024. Generally speaking, large over small has been the story. And at some point, that's probably going to change. It's not changing, in one day, but days like this make me think about that IWM chart or the S&P 600 chart, just thinking about what we would need to see to really sort of indicate a rotation into smaller names. The relative strength is obviously super important to focus in on. Small caps have come up with a number of my recent podcast interviewees, specifically thinking of Ari Wald last week. We talked about small caps in particular and expectations going forward. So if you haven't caught some of my interviews as part of the New Market Misbehavior podcast series, I would hope you do so. Actually, just making arrangements this week to finalize posting all those podcast interviews on your favorite podcast platform. So hopefully by next week at this time, you can listen on Spotify, on Apple Podcasts, on iHeartRadio, and all these other places that I am told people listen to podcasts. I do it on Spotify. All right, the VIX down slightly, actually more than slightly, down about 1.5 VIX points. That's quite a bit of a down pull in the VIX. Yesterday at the close, we were around 22. Today, at the end of the day, we're around 20.5. Now, that's still above the 20 level, which for me is an important one. And I just interviewed Tyler Wood for my podcast series earlier today. He shared a great quote from Todd Sohn at Strategist, a fellow CMT based in New York. And he had said, when the VIX gets above legal drinking age, that's when I start to get concerned. So we're back below the 21 handle here today, just slightly below it. 20 is the level for me. That's what I usually follow. So for now, I think we remain in a fairly elevated volatility environment. And that makes sense, right? Given the uncertainty about the elections, given the uncertainty, not necessarily about what the Fed is going to do this week, lowering basis points, 25, lowering interest rates or the target rate by about 25 bips is sort of the general consensus. Can't see a scenario where they're necessarily different from that. But obviously a lot to be parsed through in terms of the comments about expectations going forward. The Fed dot plots, right, with the different governors, given their expectations of interest rate policy going into the new year, the pace of future rate cuts through the remainder of this year and into early 2025. That's what we're all going to be focused on and so forth. So it makes sense that volatility is a little more elevated usually that means risk assets are going lower. Kind of a weird shape or a change in the shape of the yield curve here today. The short end, the 5-year points going up a little bit. The long end actually coming down a little bit. 10-year yield finishing just below 4.3%. Long bond yield around 4.45. Talked with my guest today, Tyler Wood. I should have that podcast out today or tomorrow. Had a great discussion about a lot of different markets, but particularly talked about the 10-year yield. And, again, differentiating between the short end of the yield curve, which is what the Fed is manipulating, right? They're moving the target rate, which is basically an overnight rate, a very short-term rate that, banks are able to borrow between each other. But then the 10-year yield is really driven by market forces. This is more expectations about future economic growth that it's being priced in here. So overall, rates have been trending higher, which suggests the market pricing in a pretty good soft landing Goldilocks kind of scenario. And so yields coming down a little bit today. That's certainly something to watch through the course of this week, particularly Thursday when we wrap up the 2-day Fed meeting and get their latest comments and updates about expectations. All right, looking at the commodity space, the DBC, which is a broad commodity ETF, up about 0.6%. Gold, precious metals, all doing slightly better today. Gold was up 0.2% using the GLD, and I do own the GLD. Full disclosure, SLV was up 0.4%. Crude oil prices as well. Besides natural gas being down, most of the commodity ETFs that we track were all in the green today. Continuing this everything up, all is well kind of day for risk assets. Bitcoin generally moving higher, up about 2.25%, currently around 69,310 or so. You can see that Bitcoin in particular reached that 70,000 level. That has been just sort of the ceiling for a while now, right? For much of 2024, going back to like March, April, May, we hit that 70,000 up to 74,000. And we've sort of tested that many times over the last 8 or 9 months. At some point, I'm pretty confident that we're going to break above that level and push to new highs. Not today. For now, we're still remaining below 70,000. I do own Bitcoin. Full disclosure, also Ethereum. All right, going over here to the sector summary, you're going to notice it's all green today. And again, kind of a nice lighter volume, but overall fairly constructive day for equities and other risk assets. You can see the XLY leading the way, higher, up 1.8%. Industrials up 1.7%, not too far behind. Utilities, generally considered a fairly defensive sector, but in times in 2024 has been a sort of a growthier play, up 1.5%. Technology and real estate not too far behind. So 5 of the 11 S&P sectors all up over 1.3%, which is a pretty decent update in terms of sector breadth, as I would probably call it. Your 3 worst performing sectors were all in the positive. Materials slightly so, just up about 1.2% from yesterday. Consumer staples and energy both up about 0.2%, we'll call it, from yesterday's close. So something to watch here. Obviously, as I mentioned, we don't update formally our market trend model until Friday after the close, but the good folks at Stock Charts keep this model updated. They run a check at the end of every trading day just to see if the models need to be changed. And then for me, Friday at the close or after the close is when I formally sort of update the models and think about what might have changed. That's a lesson there, right? One of my mentors, Jeff Weiss, who was for years at a firm called Jessup and Lamont, one of the oldest brokers in the New York area. He would always say, wait for the weekly close, wait for the monthly close. We spend too much time as long-term investors, particularly focusing on short-term movements and thinking that a movement, moment-to-moment fluctuation has broad, influence or impact. He would always just very calmly wait for the weekly close and say, until Friday's close locked in, nothing's changed, right? The last Friday is still sort of the most recent data point on those weekly charts. So this is a placeholder. As of last Friday's close, the short-term model had turned negative for me on all the major U.S. indexes. And so as of today, small caps moving up a bit, it looks like. But until Friday's close, that's when I would formally update anything. So that's sort of the general sense there. Looking at the Magnificent Seven and Friends, you can see Tesla having a decent upday, up over 3.5%. NVIDIA back in the upswing, up 2.8%, we'll call it. Meta up 2.1%. Amazon not too far behind. Worst performer of this bucket is Alphabet, still up about 1/3%. Apple and Microsoft all in the positive, just a little less than 1% higher. All right, let's go to the market carpet. The market carpet is one of my favorite visualizations to look at during the day. I actually have this on my monitor, one of my monitors in my home office here, and I keep glancing at it regularly. If you ask me what are the conditions at any particular moment, I would bring this up. And as a reminder, 3 ways that I generally use this. Number one, you take a step back and look at the overall takeaway, right? What's your general impression looking at the overall space? More green, more red, more neutral, clusters of green or red or neutral to focus on. Number 2, look at the big dogs. Look at the biggest names with the largest boxes. Those are your biggest weights in the index you're looking at, in this case, the S&P 500, and think about what that means, because they dominate our market cap weighted indexes. And so how they move, the indexes, generally speaking, are going to move as well. And then number 3, look for outliers. Look for little pockets of different information around the heat map. So step 1, right? What's your general takeaway? Pretty decent update, right? I mean, for the most part, it looks like this is a fairly constructive day. I'm seeing a lot of sectors mostly in the green. You're seeing isolated little red spots for, probably sort of one-off movements in individual stocks, maybe some earnings moves lower, but generally speaking, pretty decent update for equities. Number 2, looking at the big dogs, I'm noticing some of these up quite a bit here. NVIDIA, Broadcom, Tesla stand out. A lot of the other semiconductors like Applied Materials, Micron, Intel, all doing well. Some of the renewable energy names, which have been, sort of choppy, but having a decent week. Enphase, SolarEdge, First Solar, all in the green as well. Also, just noting things like financials with some great strength as well. All right, so the big dogs we've done, and now finally the outliers. And on a day like this, where it feels like most things were up, you want to particularly look at things that were not up, right? So what did not follow the market trend but did something different? These are your outliers. These are sort of the barbells, right? Things that were doing something unusual. And that usually tells me there's maybe some one-off stories there, or company-specific issues that are causing a particular stock to not participate. NXPI is one of those. This is in the semiconductor sector or group. Not one of the biggest names, but still a decent size, down about 5% today. ADI, Analog Devices, down about 3%. I actually grabbed that chart for our chart list that we'll review here in a moment. Within the financial sector, I'll highlight Market Access, coming off of a test of that late 23 high. I grabbed this chart as well, down a little bit today. FIS, Fidelity National Information Systems, down 3.5%. Looking over at the discretionary sector, gambling stocks getting hit pretty hard today. So Wynn, Caesars, LVS, all in the red. Wynn's the outlier, down almost 10% today. Kind of a pretty rough day there. And continuing on, Boeing also in the red. I feel like Boeing's been sort of in the red, technically speaking, for most of 2024. So I'm not terribly surprised, I guess, to see that. But let's jump to Wynn as we continue on and get to our chart review. I just want to highlight with a stock like Wynn, the reminder, even though we're down about 9+% today, and granted, that's a huge move lower. That's a big gap down. As they reported earnings, I think it was yesterday after the close. So this is sort of a reaction, got hit in the after hours, but today opened below the 200-day moving average for the first time since late September, continuing to deteriorate through the course of the day today. We didn't quite get to the oversold level, but we're very, very close to doing so. What I want to remind you is just to reflect on the fact that the month of October essentially was a retest of that February and April high. And I remember as this was happening, as we had all these gaps along the way, which you probably call continuation gaps, which are basically a gap in the middle of a move. You have what are called breakaway gaps, which are like the very beginning, right? You initially sort of move. It's an impulse move and a gap higher a lot of times on earnings. Then as the trend progresses, you have what are called runaway gaps, usually happen about halfway through the move, where you have these sort of gaps in the middle. And then as we continue, you often will get to what's called an exhaustion gap, which is that last gasp higher. An example of an exhaustion gap would be like here in February, right? We had this big run higher, then one big gap higher, and then that was kind of it. That ended up being the February peak. You could consider April as sort of a retest of that exhaustion gap day in February. And then look at how we retested resistance. So this is why I always encourage people, as you're learning technical analysis, start with the current data and look to the left. Look at where we're at now relative to where we've been. And if you've done so with Wynn, you would have noticed a very clear resistance area, sort of in this 106 to 108 range. It's pretty much where we topped out in early October. for the rest of the month of October, we've just been kind of pushing downwards, right? So if you still own Win on a day like today, I think you've missed the fact that we hit resistance and it was repelled, right? Bullish charts don't trade to resistance, they trade through resistance. Languishing charts fail and they hit a ceiling and then they're unable to push a little bit further. So, again, I think there's a cautionary tale of watching for stocks that hit a key resistance level and then fail to push through. Now, the reason why I'm spending a little time talking about this chart is I think that's a danger for some of the Magnificent Seven stocks, right? Some of these names like an Apple, which have hit resistance, but they look kind of a lot like this before Win broke down a ton, right? They're testing resistance, unable to really push through. And that causes me a little bit of concern in terms of the sustainability of the trade that we've seen off of a July-August low. So concerned a little bit in terms of the lack of follow through on those Magnificent Seven stocks. Sort of the bull scenario in a week like this with all the news flow is that those mega cap names finally get a bid and start pushing above key resistance levels. All right, let's look at the S&P 500. Excuse me, that's how you know it's live. No sneezes happen. Apologies. We're looking at the S&P 500 daily chart just to catch you up if you haven't watched the show. And as a reminder, we're streaming on Facebook, LinkedIn, YouTube, and X. I appreciate you so much wherever you're streaming the show. If you're watching live, I can see comments you're making on any of those platforms all in one place, which is why StreamYard is a pretty cool platform I'm happy we're using. So if you have questions along the way, pop them in there. I appreciate it so much. And at the end of the show, I'll try to take a question or two before we wrap the live stream and then get to watching election results, which will probably be what we're doing for the remainder of the afternoon into the evening Pacific time here. All right, looking at the S&P 500, right? So the last week, we've broken below trendline support. That's the key trend line off the August and September lows that lined up with some of the late October lows. We gapped below there. I think that was Thursday of last week, traded down to the 50-day moving average. And today, again, lighter volume, but a nice bounce off of the 50-day moving average. And I think that's important, right? When we talked about that line in the sand approach, for me, what that means is you define a level, you define an area of support. And the reason why we do that is because as long as we remain above that line in the sand, conditions are okay. If and when we would break below that line in the sand, it might not mean the end of the world, but it definitely means you need to revisit things, right? And sort of revisit your bullish thesis in this case. So I am happy to say I'm bullish on the S&P as long as we remain above 5650. If and when we would break below there, that means I have to revisit that thesis and reconsider, am I seeing any additional evidence that would maybe confirm that this breakdown has started something more significant? For now, we're bouncing off of the 50-day, which is a common place that a lot of charts find support. The RSI is bouncing off of a level just above 40, which is pretty classic within a bullish framework. So overall, this still feels like a short-term pullback within a long-term uptrend. We break 5650 here in the days to come. I would have to change that because I don't know if you could necessarily say that anymore. By the way, by finding support at the 50-day moving average, we're also holding the early October low. So we can still say the S&P is making higher highs and higher lows. That's why we focused on that particular level. And for now, we're holding that okay. The equal-weighted S&P, and yet again with my guest earlier on the podcast, Tyler Wood, and again, hope to have that out to you later today or tomorrow. So keep an eye on my YouTube channel for the latest podcast episode, talking with Tyler about equal-weighted versus cap-weighted S&P, and that idea of thinking about equal-weighted versus cap-weighted indexes has come up with a number of my guests, and I think hopefully for you that should be an indication that institutionally minded strategists and analysts like myself and like some of my peers that I'm bringing on the podcast really focus on that relationship between cap-weighted indexes, which are where a lot of capital is tied to, obviously, with passive investment products, but also equal-weighted, which gives you a better, a little more clear picture at some of the individual stocks that comprise those major indexes. And so the equal-weighted indexes and ETFs, RSP is the equal-weighted S&P ETF that we're looking at here, testing the 50-day moving average as well. Having a nice breakout from that consolidation, April, May, June, and then July, we finally break out, did pull back a bit, but overall trending higher. So we have pulled back to an ascending 50-day moving average. That's pretty much a classic pullback within a primary uptrend. So for now, even the equal-weighted S&P, I think telling you things are okay. Talking about the VIX, which is spiked higher. We've had a couple spikes above 20, going back really to late July, early August, where we pushed well above that 20 level and even went above 29. If we would have just an extended bull market from here, that might be the first time. I don't know if that's true. I'm making up data, so apologies. But from my recollection, not having the data in front of me, that might be the first time we've spiked that high in the VIX and not had a significant sell-off soon afterwards. So again, it can happen. There's nothing about the math that would tell you the S&P can't just go higher from here and that the VIX can remain kind of around the 20 level and that can be sustained for quite some time. It's just highly unusual. What is much more common is that you have a big spike in the VIX and then bad things tend to happen. Now you had that whole carry trade thing happen. The Fed rate cut cycle. There's been a lot of things that have happened, in 2024 that are sort of different, which would maybe cause some unusual signals. But again, thinking of the VIX and the general message, this would be pretty interesting if you don't really get a significant drawdown beyond what we've seen so far with the VIX spiking so high. That usually happens only when we're sort of staring over the precipice of a much more negative trend. Does that mean we're delaying things a little bit into early 2025? Perhaps. I'll look forward to tracking those emerging trends along with you through this show and elsewhere. Interest rates moving higher, and again, the story from mid-September really now through early November has been the 10-year yield in particular moving higher. And remember, when we talk about the Fed meeting tomorrow and Thursday, that's going to be all about short-term rates, right? The rates that the Fed literally controls, the ones that they manipulate as part of their mandate as a federal agency, is the short end of the curve. They're messing with a rate that impacts big banks lending and borrowing money from each other, essentially, and from the government itself. What we're looking at here is a little further out in the yield curve, what's called a longer duration treasury, 10-year yield, 10-year bonds, right? So the yield on 10-year bonds are driven more by market forces. This is how bond investors are sort of making a call on future economic growth and making bets on expectations for future economic growth. So the fact that rates are going higher like that implies some optimism, right? That things are actually improving and going to get better. And by the way, the twos versus tens, which is one of the more common ways historically to look at the shape of the yield curve, has been back to a normal shape since early September. The probably more effective way to measure that is looking at the 3-month versus the 10-year yield, because the short end has been so elevated. It is dangerously close to actually being back to a normal yield curve. So it's interesting to see how yields have evolved here just in the last 6 to 8 weeks. I would keep an eye on this because a lot of things that became investment themes in August and September, things like home builders, because all of a sudden borrowing to buy a home became a lot less expensive. Don't look now. It's actually right back to where it was over the summer, right? We're back to that sort of 4.25%, 4.5% range for the 10-year treasury yield. So this will probably be a key chart to pay attention to through this week, through the Fed meeting, but of course, going forward as well. As I was going through a series of charts this morning as part of my morning coffee routine, I did want to grab this one. This is a ratio of offense versus defense. The top panel shows the XLY versus the XLP. The bottom panel, the equal weighted ETFs that track those same sectors. This is my classic way of looking at offense versus defense. Things you want versus things you need. The idea is when things you want are outperforming things you need, that implies optimism, that implies consumers are paying for luxury goods, discretionary goods, travel, tourism, new fun things, because they have money to spend and they're pretty optimistic. And that ratio, that equal weighted ratio of offense versus defense, has made a new 52-week high in the last week. So even though some breadth conditions, volume conditions, things we've talked about have been diverging, showing some signs of short-term weakness, you're still not seeing broad distribution. You're not seeing a big rotation to defensive sectors by any means. I would say offense over defense, still very much the story. All right, finishing off looking at some individual names. I'll grab a question or two. So as a reminder, pop one in if you haven't done so already. Any of the questions we don't get to, we'll put it into the mailbag and hopefully do a mailbag show on Friday. And as a quick heads up, I'm actually traveling to Missoula, Montana. My daughter, who's in high school, is in an honors band at the University of Montana. I'm so proud. My wife and I, who are both musicians, super proud of her, and she's deserved it. She's earned it. So we're going to go there and support her. So I will be taking a little time off here on Thursday and Friday. I'll do a show hopefully later in the day on Thursday, so I might not live stream it right at the close because we'll be traveling to Montana, but I am certainly going to check in on the post-Fed action and share some thoughts with you. We'll do a mailbag episode on Friday, but I appreciate you being patient with me as I navigate all those things and personal stuff too. All right, looking at Amazon here, I would say what's key is we're testing the July peak. What's important to me over this week is that the gap that we saw on Thursday, Friday's session of last week, which is that gap from Thursday to Friday, we gapped above that September peak. I think that's important. We're now testing the July peak, which is right at $200 a share, a big round number. Amazon's setting up pretty well. I mean, if you ask me to say, is this more likely to break out or not? I would say the momentum is certainly strong, but not excessive. Generally speaking, this is really building up as a nice breakout candidate, but I'm happy being patient and waiting for that push above 200. The bull scenario for stocks in the fourth quarter, beyond what we've seen so far, I would argue has to involve these mega cap growth names following through to the upside. Amazon may be the most likely to do so here this week. We'll see if we can get the Mo above the July peak, above $200 a share. It's an important chart to watch. MarketAxess Holdings is a stock in the financial sector. Financials in general have been obviously a really interesting area to consider in recent months. A lot of relative strength, improving charts there. A lot of those ETFs like the KBE, the KRE, the KCE, the KIE, which are all the sector ETFs in the Friday in the financial sector, all kind of trending higher, generally speaking, in pretty good shape. MarketAxess, though, gapping lower. This is an earnings name. They actually report, looks like tomorrow, I'm guessing, but a gap lower today. I haven't looked into what happened particularly on the stock, but you see the gap lower, gapping below the short-term support around 285. Now, I've drawn a couple trend lines. This is an interesting one because it's been kind of a choppy rise on the way up. So the initial trend line I drew, I kept it on here, but I have it dotted in red because we actually broke that a couple times. I drew a new one from the July low and connecting that to the late September, early October low. That also was broken today. So we're breaking trendline support. We're still holding an ascending 50-day moving average. I think this is an important one to watch. We recently had a bearish divergence, new highs going into the end of last month on weaker momentum. The PPO has generated a sell signal. So it's kind of a right at a key point. I don't think it's broken down enough for me to sort of confirm, yeah, this is a downside rotation. I'd want to see if that 50-day would hold, but overall, certainly not going up at the moment. ADI is another one gapping lower today, down about 3% today. ADI is, again, a cautionary tale about recognizing when stocks don't break above resistance, that just means there are better places to be, right? There are other stocks that are breaking out. So if you have a stock that's sort of hitting resistance and just failing, I wait for it to break out as sort of a validation that something's different. All this chart has told me is that there's really not enough of an upside catalyst to change the picture. Now we're gapping lower. Now we're contending with the 200-day, contending with the September low. So still okay from a technical perspective, but very close to breaking down. Again, I think the lack of follow through above that 235 to 240 range is really the story there. Palantir, if you're looking for an example, what kind of charts just keep working? PLTR, probably hard to find another one like this, like Sprouts, SFM is another one that come to mind. There are these group of stocks that just continue to just pound to the upside, keep making new highs. Earnings name yesterday, positive reaction, up almost 25% today. Nice follow through yet again after a series of upside gaps around earnings. This is one of those stocks that just continues to compound gains on an adjusted basis. End of last year, it's down here in the high teens. Now we've broken about $50 a share. And what I love about this chart is it's a great reminder. I have a lot of times when a stock gaps above resistance and it's overbought, I get people saying, uh-oh, should I avoid it? And my answer is, this is how big sustained gains often start. And I learned that from working with portfolio managers at Fidelity. They would see charts like this and say, this is a great company that's now in an emerging growth phase, and the stock is being rewarded, right? The stock price is reflecting that optimism and that continued optimism about future opportunities. So don't be afraid to buy new 52-week highs. Don't be afraid to buy things when they become overbought, particularly when they're breaking out. That usually and often means the beginning of much further gains to the upside. All right, final chart, super microcomputer. Everything I just said, flip it over, and that's kind of what SMCI is doing here in recent months in a clear decline. And I would say what has been the most damning evidence about super microcomputer, all these times when we make a new low and then we make a lower high, and then we fail to get above there, right? Look at how it stalled out here around 95. Look at how we stalled out here around 63. Look at how we stalled out here around $50. And now we're bouncing higher. But the problem I have with this stock is we have a bunch of times where we gapped lower, we trade. So maybe this is a trade. Maybe when it's oversold, you think of this as a swing trade. I don't have a problem with that. But thinking of this as a big bottoming pattern, I have a huge problem with making any sort of guarantees of that nature, because what we've seen here is every time we make a new low and we have this nice rally off of an oversold level, we've sort of plateaued and we hit resistance and then we fail to follow through. Get excited about a chart like this when it actually follows through above a recent resistance level and doesn't fail to hold that. So I would see any bounce here as a trade and not an investment until proven otherwise, until we can really materialize some signs of accumulation. I'm not seeing that yet. All right, those are all the charts I had prepared. I would love to take a question. I got some questions on earnings, on the elections. I will definitely not tell you a prediction there. And yeah, I would tell you as much as people will claim to say anything about looking at evidence in the markets and sort of what does that mean? I mean, what you have to remember is that, again, the elections are very much an unknown still at this moment. We don't know. Even the polling data, if we've learned nothing else in the last couple of cycles, it's the fact that polling data is questionable at best. There's so many flaws in how those things are done and the conclusions you're able to draw. So you just have to wait until the votes are counted. And that's the beauty of a place like this, is hopefully that is something we continue to do for the foreseeable future. All right, let's see here. Question from YouTube. Bevan, thanks for watching. Hi, Dave. The Brazilian stock market has been in decline for a very long time. When markets have been in long-term downtrends, does that make any upward move more explosive? Really good question, right? And I think if you look at like the EWZ, which is probably usually the way that I look at Brazil, right? So I think what you have to remember when you're looking at non-US ETFs, especially if you are based in the US, or you're thinking of that in dollar terms, what you have to focus on is this relative performance line, right? So regardless of what you think about the price action, the challenge for owning the EWZ versus some US benchmark is this: that in the year 2024, owning Brazil means you are guaranteeing yourself that you've underperformed, right? I mean, it's just been such a drag on performance. And unfortunately, most non-US markets have that particular configuration because the US market has been so strong. And so you're not really benefiting from having a big international exposure in your US-based portfolio. If you're outside the US and you're thinking about other, local terms, different story potentially. But even in local terms, Brazil's not been a particularly strong place to be. Now, the EWZ, I would say, to your point, are we testing a key support level? Absolutely. Would I agree with the idea of betting on some short-term mean reversion and trading more toward the upper end of this range? I don't have a problem with that. I think you could justify that by thinking about testing support levels, by thinking about the momentum characteristics, using something like MACD or PPO to confirm that a bounce is maybe happening. If I was focusing on the swing trading timeframe, I would have no problem with that and sort of justifying, taking a speculative position on a bounce higher. And I have an opportunistic part of portfolios that I run just for that reason, to find things like this that I think might be an interesting short-term bounce. Maybe I want to play that as a speculative position. And maybe if it continues to work, it builds into a larger position that I would add further weight to. But the long-term challenges are exactly as you're implying in your question, right? This is a market that is below 2 downward sloping moving averages. And at a time when most markets are above 2 upward sloping moving averages, I think you're really struggling if you're really, I think, questionable justification of a long-term position in a market that's been underperforming others by so much. So those are some thoughts on Brazil. Again, as a short-term play, I get the argument of buying weakness and betting on mean reversion. More of a swing trading approach would totally say you could justify that based on some of the things that I mentioned. But the long-term story, it's about the relative strength that's been so consistently negative, and that's why something there would not be particularly meaningful. Rich watching on YouTube. Dave, isn't SMCI under investigation for irregular accounting practices? So why would you consider investing in them? So to be clear, I hope that's not the takeaway you got from my comment, which was, I actually, as I said, I don't think it's a particularly good chart. And again, what you have to remember is what I'm describing on the show when I'm bringing up a chart like SMCI. This is not a master class in accounting methods and irregular accounting practices and what that means. I would argue there are other YouTube channels that I would probably watch to learn more about that, not this one. What I would tell you, my goal is to help you appreciate the technical analysis trends, help you appreciate the idea of momentum-based investing, trend following, and recognize the fact that the chart tells you plenty of what you need to know. One of my former analysts at Fidelity, Mark Dibble, shout out to Mark at the team at Fidelity, continue to do great work here. He would love to show a chart, and I forget what it was, like Krispy Kreme donuts or one of those that, years ago had just this string of accounting irregularities, similar to what we've seen with SMCI. And it was like every month or two, you'd have a new headline that was something, the CFO resigning, all of a sudden the auditors resigning, all of a sudden some other news that related to restating earnings going back for a couple quarters and all sorts of challenges. It turns out they just were not making or had the amount of money that they kept saying that they did, right? But what was funny was the chart was actually deteriorating all through that point. And so his comment was how a fundamental analyst would interpret Krispy Kreme donuts. And it was like all these headlines, just this running total of all these headlines talking about the accounting issues. And it was like how the chart analyst or how the technical analyst would do it. It was like this big line. It broke down. It's like, so the argument is you don't need to know all the details about their accounting regularities. When the chart is doing what this kind of chart is doing, I want to avoid it just by the fact that the technical configuration is so negative. I don't care what it is. Either the company's not earning money, people are not optimistic about what's going on, there are accounting regularities, their catalysts for growth have completely changed, right? Something is happening that is causing this amount of distribution. The most important thing I would argue, and hopefully you take away from the show, is pay attention to the chart. And if you buy things where the price is going down, price goes down for a reason. And a lot of times we don't know those reasons completely until way later when we look back and find out, okay, that's what was actually going on with the stock during that period. So to be clear, I don't think this is necessarily a good idea at all. And I would say one of the main reason why I don't is not because of accounting regulators, it's because the chart tells me this is not a good chart to own. And good thing is charts tend to point you away from things where there are fundamental issues because investors don't want to own them either. Great questions, by the way. Thanks so much. And I appreciate you asking some thoughtful questions along the way. As a reminder, we broadcast our live stream every weekday after the close. Again, Thursday, Friday this week. Going to be a little different as I'm going to be on the road, but I will do my best to get some thoughts out to you through Chart This. The timing might be a little off. Thanks so much for all the thoughtful questions. Any of the questions we didn't get to, we will put it in the mailbag. And on Friday's episode, look forward to taking some time off and going through some of those answers with all of you. For Market Misbehavior, I'm Dave Keller. And remember, it is always a good time to own good charts. Happy Election Day, everyone. Please go out and vote if you haven't done so already. And we'll see you tomorrow.